In the span of 48 hours, something that was supposed to be quiet suddenly became loud. Not because silver exploded higher, not because a mine shut down, not because an exchange halted trading. It became loud because a reporting rule that many people treated like a myth snapped into focus as a real mechanical trigger. In a single calendar year, 401,112 separate Form 8300 reports were filed into the federal pipeline. That's not a handful of edge cases. That is a machine that runs every day, collecting identities, dates, amounts, and patterns. It cares what the payment method and the threshold say. The phrase sounds like a promise. It suggests there's a clean, simple way to buy physical metal, follow the rules, and still stay invisible. Walk in, pay cash, walk out. No trail, no problem. The reason this story spread is not because everyone was lying. It spread because the system used to feel slower, more fragmented, and easier to misunderstand. When paperwork is slow, people assume it's rare. When reporting feels manual, people assume it's optional. When they don't personally see the back office process, they assume it doesn't exist. But starting January 1st, 2024, the routine got more automated. For many filers, electronic filing became the expected path, which meant reports could be transmitted and standardized faster than before. That shift did not invent a new reporting law. It tightened the feedback loop. It reduced the time between a transaction and a searchable record. And it made it harder for a business to treat filing like a casual afterthought, especially in industries where large cash payments are common. Here's the pattern interrupt. The dramatic event is not a headline about silver. The dramatic event is that a rule that already existed is now wired into a more consistent workflow. Institutions already live in this reality. They assume forms. They assume audits. They assume monitoring. Many retail buyers still think in terms of folklore, like the rules are something you can outsmart with a clever payment method. That gap between institutional assumption and retail myth is where the stress appears, and it shows up at the exact moment people want things to be simple. Welcome to Meridian Ledger, where we translate rules, filings, and market structure into plain language before it becomes the story everyone repeats after the fact. If you appreciate calm, number-driven analysis, subscribe the way you would keep a wise elder in your circle. Not for noise, but for signal, and comment where you're watching from, because the same metal can feel very different depending on the country, the dealer, and the payment rails you have access to. Now let's lay out what actually happened, because the confusion starts with two conversations that get mashed together. One conversation is about taxes when you sell something for a profit. The other conversation is about reporting when a business receives a large amount of cash. Form 8300 lives in the second conversation. It's a cash receipt reporting form that applies across industries. The core trigger is simple and specific. If a trade or business receives more than $10,000 in cash in one transaction or in two or more related transactions, it generally has to file Form 8300. That is the tripwire. It is not a rumor. It is not a dealer preference. It is a threshold rule tied to how the payment is made and how the payments relate to each other. This is where normal expectations break. Many people assume the report only happens if someone shows up with a duffel bag of bills. They assume it's only for obviously suspicious situations. They assume the dealer can decide whether to file. But compliance is not a vibe. It's a checklist. Once the trigger is hit, a reputable business files because the risk of not filing belongs to the business. Even if a buyer is indifferent, the dealer is not free to be indifferent. In everyday speech, cash means paper currency. In reporting language, cash includes currency, yes, but it can also include certain monetary instruments in certain circumstances. Cashier's checks, money orders, and traveler's checks can be treated as cash depending on how they are used, the amounts and the context of the transaction. That means a buyer can sincerely believe they are avoiding cash by using an instrument, while the reporting definition may still treat the payment as cash for the business receiving it. This is the part no one likes, because it doesn't feel intuitive. People think privacy is a property of the object they buy, like metal is anonymous by nature. But privacy, in practice, is a property of the transaction structure. It depends on payment method, thresholds, related transactions, and the dealer's compliance obligations. The metal doesn't decide. The payment channel does. Now add the concept of related transactions. This is where the stay under the limit strategy collapses. If someone makes a $9,800 cash purchase today and a $900 cash purchase tomorrow as part of a single plan, the buyer may feel they stayed under the threshold in each moment. The compliance view can treat those as related transactions that cross the threshold in total. The point is not to accuse anyone. The point is that the rule is designed to see aggregation. It's designed to catch patterns that look like deliberate splitting. Notice how mechanical that is. It doesn't require a dramatic confrontation. It doesn't require a dealer to prove intent. The existence of related cash receipts that exceed the threshold is the trigger for the business. And once more, filings move electronically. The distance between receipt and report can shrink. That's why people suddenly feel like the system changed, even though the core rule has been there. So why connect this to silver at all? Because silver is one of the places where people are most likely to combine large, urgent purchases with payment methods that create reporting triggers. Silver is not only a monetary symbol, it is also an industrial commodity. It is bought for many reasons, but when uncertainty rises, the demand pattern changes. More people prefer physical. More people want immediate delivery. More people want to use a payment method they believe preserves privacy. Those are exactly the conditions where cash thresholds become relevant. And the silver market is famous for dislocations. There is a reference price set through large liquid venues. There's the retail price, which includes premiums, fabrication, and distribution costs. There is what a chart says, and there is what a person pays for an actual bar in hand. These layers can align for long stretches, and then suddenly they diverge. When they diverge, emotions increase and transaction sizes can jump. That is when the boring rules become important. To see the hidden pattern, look back. Every time regulators digitize a reporting choke point, the public experiences it as a sudden tightening, even if the rule existed for years. In 1979 and 1980, inflation and energy shocks drove intense interest in hard assets. Result: rapid price moves, operational stress, and a public that learned about market plumbing the hard way. In 2008, the crisis was confidence in banks and credit. Result: demand for physical surged, and retail premiums often separated from the reference price because supply chains couldn't instantly expand. In 2020, disruption hit logistics, minting capacity, and retail distribution at the same time demand spiked. In each case, the same playbook appeared. First, uncertainty spikes. Then, people seek assets that feel tangible. Then, the infrastructure around those assets tightens: inventories, credit terms, spreads, and rules. In 1979, the conversation was inflation and scarcity. Result: volatility and attention. In 2008, the conversation was solvency and trust. Result: flight to perceived safety and a widening gap between paper references and physical availability. In 2020, the conversation was disruption and fragility. Result: a bottleneck that made physical supply feel finite even when the broader market appeared liquid. Now, in the current environment, the pattern is repeating in a new form. It is not only about price, it is about systems. The silver ecosystem has layers: exchanges, clearing, vaulting, refineries, wholesalers, and retail dealers. Government reporting rules sit alongside that ecosystem because cash flows through the same channels. When uncertainty increases, the ecosystem is stressed in multiple ways at once. Let's name the players without dramatizing them. There are exchanges that standardize contracts and generate reference prices. There are banks and clearing members that manage settlement and risk. There are vault operators that store large inventories. There are government bodies that set reporting requirements for large cash receipts in business. And there are dealers who sit at the intersection, translating institutional infrastructure into something a retail buyer can access. Consider the vault layer because it provides scale. $4 billion stored across roughly 927,254 bars. That number doesn't tell you what will happen next. It tells you that the physical market is large, centralized in important hubs, and tracked in ways that institutions respect. Big players think in inventory, custody, and liquidity. Now consider the compliance layer because it provides the rulebook. Form 8300 exists to report large cash receipts by a trade or business. The business is responsible for filing when the trigger is met. That means the dealer's process matters. A reputable dealer will have policies, training, and systems designed to recognize when a transaction triggers reporting. A reputable dealer will also be cautious about transactions that appear structured, because the rule is designed to detect aggregation and patterns. This is where the institutional movement shows up in plain sight. Institutions and well-run businesses do not wait to be surprised. They build systems that assume scrutiny. They standardize documentation. They prefer rails that are easy to reconcile. And when electronic filing becomes routine, the operational cost of filing decreases, while the risk of not filing becomes more obvious. So the industry adapts, not because of fear, but because of process. Here's the dislocation that matters. Many buyers focus on the idea of anonymous buying, but the real lever is the definition of cash and the threshold of more than $10,000 across a transaction or related transactions. People debate privacy on forums while the actual compliance trigger is sitting in the payment method. That creates situations where someone thinks they are being careful, but they are actually stepping directly onto the reporting tripwire. There is another dislocation layered on top: the difference between official narratives and practical behavior. Officially, the rule is simple. Practically, businesses must interpret related transactions, document their reasoning, and manage risk. That means two dealers can behave differently even under the same rule, depending on their systems and their tolerance for compliance risk. The buyer sees inconsistency and assumes the rule is arbitrary. The reality is that businesses are trying to avoid being the weak link in a compliance chain. Now let's anchor this with evidence, because the numbers matter. The threshold is more than $10,000 in cash received in one transaction or related transactions. The volume is illustrated by 400-112 Form 8300 reports filed in a single year. That scale tells you this is a normal, recurring reporting flow. And the procedural shift beginning January 1st, 2024 toward broader electronic filing means the flow can be faster and more standardized than it was when paper filings dominated. But the rule applies to the business receiving cash. And precious metals are one of the obvious categories where payments can cross that threshold, especially when buyers want multiple ounces, multiple bars, or higher value products. Now let's explain the mechanism in a way that removes the mystery. Think of Form 8300 like a smoke detector. The detector doesn't accuse anyone of arson. It detects a condition. When smoke crosses a threshold, it triggers. Form 8300 doesn't require a dealer to declare a buyer guilty of anything. It requires a dealer to report when cash crosses a defined threshold in the context of business activity. Related transactions are like smoke drifting across rooms. You might not see it in one room, but the building system recognizes the total condition. Then add digitization. A smoke detector connected to a building monitoring system creates faster alerts than one that only beeps locally. Electronic filing is the building system. It makes reporting more consistent and less delayed. It doesn't make the system all-seeing. It makes it more standardized. That alone changes how compliant buying feels, because it reduces the ambiguity that people use to hide behind. Here's where it gets interesting for the silver market itself. When volatility rises, other parts of the system tighten too. Exchanges can raise margin requirements to manage risk. Wholesalers can adjust credit terms. Dealers can widen spreads or change payment policies. None of these actions require a secret meeting. They are responses to the same pressure. Uncertainty raises the cost of risk. And when the cost of risk rises, the market becomes less forgiving of sloppy processes. So what does all of this mean forward? It means the old assumption that cash equals private is less reliable in practice, especially above thresholds or across related transactions. It means the use of certain monetary instruments may not deliver the privacy effect people assume, depending on how the instrument is treated under reporting definitions. And it means reputable dealers will increasingly treat compliance as part of customer service, because surprise at the counter is bad for everyone. In a conservative scenario, nothing dramatic happens. Reporting remains routine. Dealers file when the triggers are met. Buyers adjust expectations. The market continues to function, and the main change is that fewer people are shocked by a request for information when cash thresholds are crossed. In a moderate scenario, volatility in metals drives a surge in physical demand at the same time that compliance systems are more automated. The friction shows up as longer processing times, stricter payment policies, and wider spreads between quoted references and what people actually pay for immediate physical. The headline is still price, but the experience is shaped by infrastructure. In a more aggressive scenario, stress in the broader financial system leads to heightened scrutiny of large cash movements generally. That could increase the sensitivity around any industry where cash payments over thresholds are common. Historically, when scrutiny rises, businesses respond by tightening procedures, not by taking on more risk. Again, this does not require a new law, it requires attention. What should be watched is not a rumor, but signals. Watch whether retail premiums diverge from spot for extended periods, indicating strain in fabrication or distribution. Watch whether dealers change payment thresholds, accept fewer instruments, or emphasize rails like bank wires because they are easier to reconcile. Watch whether compliance language becomes more explicit at point of sale. Those are indicators of a system tightening through process rather than drama. Now, a crucial point. None of this is about telling anyone what to do. This is about understanding how the system behaves. The system is built to reduce uncertainty for institutions and increase visibility for regulators. When it works, it creates predictability. When people misunderstand it, it creates shock. This is why the divide is not between smart people and not smart people. It is between those who pay attention to definitions and those who repeat slogans. The market rewards clarity. It punishes assumptions. Institutions move first because they have teams that map rules to workflows. Retail often moves last because retail learns from stories, and stories are rarely precise. If you've ever wondered why a dealer can feel cautious even when a buyer feels innocent, this is the reason. The dealer is running a business inside a compliance environment. The dealer's risk is not only market risk, it is process risk. A missed filing can be expensive. A pattern of missed filings can be worse. So reputable dealers build systems that trigger reporting mechanically when thresholds are crossed. That's not personal, it's operational survival. And if you've ever wondered why the phrase compliant silver buying is fading, this is why. Compliance is not a single category. It depends on the payment method, the amounts, the timing, and whether transactions are related. The old promise implied a universal path that stayed invisible. The reality is a set of rules that are designed to reduce invisibility in large cash flows. So when someone says compliant silver buying is over, the accurate interpretation is this: the era of comfortable ambiguity is over. The system is faster. The definitions are broader than everyday language suggests. Related transactions matter, and electronic filing makes the process more consistent. Silver will continue to trade. Vaults will continue to hold inventory. Charts will continue to move. But when the next stress cycle hits, the details will matter more than the slogans. Because in stressed periods, the market doesn't only test price, it tests infrastructure. To make the historical pattern undeniable, zoom in on how visibility always expands in steps. In the 1970s, the step was a shift in the global monetary framework and the public relearning what inflation does to purchasing power. In the 2000s, the step was the normalization of digital records, where everything from trades to transfers becomes easier to store, search, and cross-reference. Each step creates the same emotional response. People feel like the rules suddenly became stricter, when in reality the system became more readable. A paper price on a screen is designed to be seen. A vault total is designed to be audited. A large cash receipt by a business is designed to be recorded. The friction happens when people act as if the system's design goal is privacy, when in reality the design goal is legibility. Now look at the silver dislocation through that lens. The paper market is built for speed. It is built to express risk, hedge exposure, and transfer price discovery efficiently. The physical market is built for custody. It is built to turn raw metal into specific products, move it through logistics, and store it securely. When the two align, the world feels stable. But the more accurate view is that they are different layers with different constraints that sometimes separate under stress. When physical gets tight, the constraints show up as delays, premiums, and rationing. When paper gets volatile, the constraints show up as margin changes, reduced leverage, and faster forced selling. If both happen at the same time, the pressure can funnel buyers toward the simplest, most immediate form of purchase they can imagine. And that is exactly when the reporting trigger becomes relevant, because the payment method is colliding with scale. This is also why dealer behavior can change quickly. A dealer who happily accepted certain payment methods in calm markets may tighten policies in stressed markets, not because their values changed, but because their risks changed. In stress, counterfeits rise, chargebacks rise, delivery risks rise, and compliance attention rises. Dealers may ask more questions. They may prefer payment rails that settle cleanly. They may impose waiting periods for certain instruments. They may raise thresholds for what requires additional documentation. The customer experiences it as a sudden clampdown. The dealer experiences it as survival in a higher risk environment. If there is a single misconception that causes the most pain, it is the belief that privacy is guaranteed by the absence of a single form. In reality, privacy is shaped by a mosaic: store records, payment records, shipping records, bank records, and reporting rules that apply to businesses. You can dislike that, you can debate it, but you cannot plan intelligently without acknowledging it. So the forward-looking posture is not fear, it is literacy. Literacy means knowing what triggers reporting, knowing that cash can mean more than bills, knowing that related transactions can aggregate, and knowing that compliant is not a secret handshake. It is a set of definitions applied by real businesses that have their own survival incentives. This is Meridian Ledger, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. Because the question isn't whether systems like this keep getting more automated. The question is whether the understanding is already in place before the next wave of volatility turns a simple purchase into a surprise at the counter.